The title is pretty direct. DNN to $5. Uranium boom plus Phoenix project equals BUYNW.
Doesn't leave much to the imagination, does it?
Not at all. And our mission today is to really peel back the layers on this extremely bullish take on Denison Mines, DNN.
And see if the catalysts they're pointing to actually justify, well, a potential doubling of the stock price. It's a big call.
A huge call. And what's interesting is this report, dated January 10th, 2026, it doesn't frame this as just some quick trade.
No, not at all. It goes much deeper. It calls the company a structural play on the massive uranium supply deficit.
Structural play. That's a pretty strong phrase.
It is.
So you're saying this isn't just about, I don't know, timing a good headline or something.
Exactly. The report's whole argument is that the underlying mechanics of the global energy grid have changed for good. There's this massive long-term gap between uranium supply and demand.
And DNN is sitting right in the sweet spot to fill that gap.
That's the structural element right there.
Okay, so that really sets the stage. And the report kicks off with this really provocative question.
It does.
It asks if the recent pullback in DNN is an exit for the, quote, weak hands, or if it's the dip buying opportunity of a lifetime before this thing blows past $5.
A classic setup.
It is. Okay, let's unpack this. Let's start with the immediate picture of the stock chart. What actually triggered this analysis?
Well, what happened was DNN had just hit a fresh 52-week high. It touched $3.51.
Okay.
But then it cooled off a little, closing the day around $3.31. And that specific movement, hitting a new high and then retreating, that's what got the chart watchers talking.
And the analysis points out that the candlestick pattern is what's called a shooting star.
Right.
Which, for anyone who doesn't follow the charts, that's usually a bad sign, right?
It is, yeah. A classic reversal signal. It suggests a pullback might be coming.
But the report just dismisses that completely.
Throws it right out. They label that candle not as a warning, but as a breather.
Hold on, isn't that a little biased?
Yeah.
I mean, if your whole thesis is this bullish, wouldn't you just explain away any bearish signal?
That's a very fair point.
What's the risk you're ignoring when you just call a shooting star a breather?
Well, the risk is that profit-taking can accelerate, And not every pullback is just a healthy pause. But the argument here is all about the context of the trend.
The uptrend is just too strong.
That's what they're saying. The overall trend is so powerful that a slight retreat after a new high is just necessary consolidation. It's the market, shaking out people who are just looking for a quick 10% gain before the real move higher.
So they're betting the macro story is just going to overpower this little technical signal.
Exactly. And that brings us to their strategy. This report gives super specific entry points,
turning it into a real tactical plan for you.
Absolutely. They flag the support range as being between $3.25 and $3.28.
And that's where they say you should be loading the boat.
Right. Which, to be clear, just means buying aggressively.
High conviction buying.
As much as you can. And on the flip side, the resistance is that recent high, $3.51.
And if it breaks that?
Then you're in what they call blue sky territory. There's no recent price history to act as resistance, which opens up a clear path to $4, and then that big psychological number.
$5.
$5.
Okay, so the charts are tactical, but they're still just predictions. What's the actual physical news that makes this case so solid? This brings us to catalyst number 1.
The Phoenix project de-risking. This is the big one.
This is huge.
The breaking news from January was Denison announcing they had completed the Sask Power transmission line.
And what does that mean?
It means they've connected their future mine site to the permanent electrical grid.
We need to pause on this because running a power line sounds kind of minor. Why does this report call it a massive de-risking milestone?
Because it's absolutely transformative for a remote mine in Saskatchewan. Building and running a mine takes an immense amount of continuous power.
Right.
Before this power line, the whole plan depended on diesel generators. Oh, wow. So you're talking about volatile fuel costs constantly trucking in diesel.
A logistical nightmare and incredibly expensive. The grid connection just erases that entire financial and logistical burden.
It locks in cheaper, more reliable power.
Yes, which means their future operating costs drop, their construction schedule is safer, and it's a huge signal to the market that this is moving from a plan on paper to a physical reality.
It proves they can execute. So what's the next step now that the power's on?
The company is now officially construction ready. All they're waiting for is the final investment decision, the FID.
And that's expected this quarter, Q1 2026.
Any day now. And this is where the report makes its boldest short-term call.
What's that?
It claims that once that go signal, the FID, is announced, the stock likely won't be under $4 ever again.
Wow, that is extremely aggressive. They're tying a bureaucratic decision to a permanent 20-30% jump in the stock's floor price.
They are. Their justification is that the Sask Power line was the last physical hurdle, the final barrier that could cause a major delay or a cost overrun. So the rest is just paperwork.
Pretty much. The market sees they can execute, so once the capital commitment is official with the FID, the stock is just going to re-rate instantly based on that new certainty.
But a new mine is only valuable if the world actually needs what it's producing.
Of course.
So let's pivot to the bigger picture. Catalyst number 2. Why does the world suddenly need so much more uranium? What's behind this global uranium squeeze?
This is the engine for the whole thing. The report is adamant that the uranium deficit isn't some temporary cycle. It's structural, and it's getting bigger, fast.
And the driver is this desperate need for clean, reliable, what's the term? Baseload power.
Baseload power, exactly.
Yeah.
And the analysis points to two massive growth areas that are just exploding in demand.
AI data centers and EV grids.
Total game changers. I mean, we're not talking about small server farms anymore. An AI data center can consume as much power as a small city, and it needs that power 24/7.
It can't fluctuate.
It can't. You can't train a large language model on intermittent solar or wind. And it's the same problem with EV grids. When everyone plugs in their car at 5 p.m.,
that's a massive synchronized power draw on the grid.
A huge spike. And while solar and wind are critical, they can't guarantee the power is there when you need it most. Nuclear is really the only carbon-free source that can deliver that kind of dense, reliable, round-the-clock power.
So it's a renaissance driven by pure necessity.
Exactly. And at the same time, the supply side is struggling. The report notes that major producers, like Kazatomprom, are having trouble meeting their own targets.
Which just accelerates the squeeze.
It creates a perfect storm.
Yeah.
So you have this rocketing demand hitting a supply chain that's slow to respond, and that's why Denison's key advantage is so important.
Their asset.
They control Wheeler River, which is one of the highest-grade undeveloped uranium deposits in the world.
They're sitting on a premium asset that's cheaper to mine right at the moment the world is desperate for the product.
That's the whole structural play thesis in a nutshell. They're positioned to be a high-margin producer for decades.
Okay, let's talk about the money. Building a mine like this is ridiculously expensive. So many junior miners just get crushed by dilution.
Constantly raising capital, yeah.
But this report says Denison's balance sheet is a fortress.
It's the financial bedrock of the whole thesis. The analysis says Denison has a war chest of roughly $700 million US.
Wow.
That's a combination of cash and physical uranium holdings. It's a massive safety net for a company that isn't even producing yet.
700 million. But wait, it says cash and physical uranium?
Right.
How much of that is liquid cash versus a commodity that, fluctuates in price?
That is the smart question to ask. The report doesn't give the exact breakdown, but you're right, a big chunk of that war chest is tied to the price of uranium itself.
So if uranium prices fall, their fortress gets a little smaller.
Technically, yes. But the report is so bullish on uranium that they see those holdings as appreciating capital, not just a risk.
Okay, but either way, why is having that much liquidity so important for investors right now, even before the big decision?
It's the insurance policy, it's what you said. It protects them from that death by dilution that kills so many other junior miners.
They don't have to keep going back to the market for money.
Exactly. With $700 million, they can push through final permitting, they can start early construction, all without having to issue a ton of new shares that would kill the stock's momentum.
So this raises a question for me. If they have the money ready and the project is now construction ready, why is production still not slated until mid-2028?
That's the timeline critique, right?
Shouldn't that financial stability let them speed things up?
You'd think so, but the bottleneck isn't funding anymore. It's regulation and the physical realities of construction. The money just means they are highly reliable to hit that 2028 target.
Not that they could beat it by a year or two.
Exactly. In this industry, reliability is what the market pays for, and that's what the $700 million buys them. Reliability.
All right, let's get to the payout. Part 5. The price targets in this report are, well, they're not shy.
No, they are very aggressive. They reflect this total conviction that the FID is a done deal and uranium's price is only going up.
So break down the timeline for us. What are the targets?
Okay, so short term, that's the next 1 to 3 months. The target is $4.15.
And that's based entirely on the FID announcement.
Purely. It's a market pricing in that final confirmation.
And then the path to $5.
That's the midterm target, so 6 to 12 months out. They see $5 plus as construction gets underway, and the global spot price for uranium keeps climbing.
And long term, the report even mentions double digits.
It does. That's the blue sky scenario for 2027, 2028. It's contingent on, a smooth construction process and production starting on time in mid-2028.
Delivering that high-grade uranium into a market that's starving for it.
That's the vision, a vision that assumes the whole nuclear renaissance plays out perfectly.
So the bottom line here, the report's conclusion is a strong buy with a rocket emoji.
You can't forget the rocket emoji.
And they keep coming back to the Sask Power connection, calling it the final infrastructure hurdle.
The message is simple. Operational risk is way down. Financial risk is basically zero. The path forward is clear.
And for you listening at home, the strategy in the report is very specific. It says, use this pullback to $3.30 to start building a position. If it dips to $3.15, back up the truck.
Yeah, and that phrase, back up the truck, that's the ultimate sign of conviction. It means the analyst thinks a dip to that level is a gift from the market.
An error to be taken advantage of.
A huge opportunity for maximum accumulation before the rest of the market catches on.
So what does this all mean when you put it together? You've got this incredible convergence, a major de-risking event with the power line.
A fortress balance sheet that prevents dilution.
And this massive long-term global demand squeeze from things like AI and EVs. This analysis is basically saying DNN is sitting at the intersection of all three.
Yeah, and if you connect it to the bigger picture, this report isn't just about one company. It's framing Denison as sort of a bellwether for this entire nuclear renaissance.
The premier vehicle for this huge energy shift.
Exactly. They see it as an inevitable shift, driven by our need for dense, clean, reliable power. And DNN is just the best way to play it.
Absolutely. Well, the report focused so heavily on the demand from AI and EVs and how that drives the need for nuclear. But here's a final provocative thought for you to consider.
Okay.
The analysis celebrated the SAS power line, and rightly so. But what other hidden costs or secondary infrastructure projects might be needed before those double-digit price targets can really be achieved? I'm thinking about things beyond just the mine site, like do they need specialized transport, faster regulatory approvals for refining, a bigger pool of skilled labor? It's just something to keep in mind as this whole nuclear shift unfolds.